Trade and capital movements are like the wheels that keep the economy moving forward, especially for businesses. Think of it how as money flows in and out of the country, shaping things like exchange rates and investment opportunities. When we talk about trade, it's not just about buying and selling goods. It also includes things like money sent by overseas workers back home or profits sent by the foreign companies to their own countries. While capital movement cover both foreign investment coming into the country and investment made by Filipinos in other countries. This can be short-term deals or long-term projects. Financially, our flows are all about the money moving around the world like international debt or loans and paying back what's owed. Understanding these movements is crucial for business because they affect things like market conditions, where to invest, and how stable the economy is. The balance of payments BOP measure the money coming into and going out of a country, mainly in dollars. It's like keeping track of how much we earn from other countries, which is inflows, and how much we spend on them, which is outflows. If we have a surplus in the BOP, it means we're making more money from selling foreign currencies for pesos than we're spending on buying foreign currencies with pesos. This is good for the economy. But if we have a deficit, it means we're spending more on foreign currencies than earning, which isn't so good. So the BOP help us see how well our economy is doing and if we're managing our money wisely on the global stage. Now, when money leaves, it's usually for buying stuff from other countries, paying for services or settling for debts. But when money comes in, it's from things like people sending money from overseas or selling foreign monies to reserves. Currency exchange rates have to sell extra foreign money they have to the central bank for local money. This helps boost the amount of local money floating around. That's good because it means more money for people to spend. But if there's not enough foreign money coming in the country has to buy more from the central bank. It can shrink the amount of local money, which isn't great. The government acting through central banks step in to manage the foreign exchange market, ensuring stability in currency values. When there's an excess of foreign currency available, the central bank buys its using local currency, which is pesos. The fact that are shipped from D to D, which is demand to demand to balance the market. Conversely, if there's a shortage of foreign currency, the central bank sells some of its foreign reserves, shifting the supply curve from S to H, which is supply to meet the demand and maintain stability. This intervention helps prevent sudden fluctuation in exchange rate, which is crucial for businesses and other overall economy.
Basically, the economy relies heavily on bringing in things like machines, materials, and finished products from other places, even though it could make some of these things itself. But when it comes to what it sells to other countries, it's mostly basic stuff like farm goods and minerals with a bit of low-tech stuff like clothes thrown in. Local manufacturing mostly focuses on making simple things like food and other everyday items, but it struggles to compete with all the important stuff flooding the market. When you hear about the country exporting machinery and electronics, it sounds impressive. But in reality, a big chunk of those exports are just things put together locally from parts that were brought in from other countries. This doesn't do much to boost the local economy because it doesn't create many local jobs or make good use of local resources. Our country isn't selling much to other countries, but we're buying a ton from them. This leaves us spending money that we're making in foreign currencies like dollars, but we're getting some extra cash from loans and money sent home by overseas Filipino workers or OFWs. This helps balance things out a bit, but we're still not doing great in trade. Now, because we're buying so much from other countries, the value of our money compared to theirs is pretty high. This means it's expensive for us to buy things from them, but our stuff is cheaper for them to buy. The problem is our local businesses struggle to compete with cheap imports. They can't afford the fancy technology and materials they need, and they have to deal with high costs because of expensive imports, so they end up making simpler stuff and trading cheap items instead. Ay, isa-isa. Ano na lang, itrato na lang yun. So they end up making simpler stuff and trading cheap items instead.
So back in 2012, our peso was getting weaker compared to the dollar, mainly because prices here were going up. This made the peso seem more valuable than it really was compared to the dollar. At the same time, there were some economic worries in the US and Europe. So investors were looking for opportunities in Asia, including here. Because our peso wasn't worth as much as before, imports become cheaper for us, but it made it harder for our stock to compete internationally because it got more expensive. Even though neighboring countries were trying to strengthen their currencies, our peso kept getting stronger against the dollar. This made us need more dollars to balance things out, especially since we rely a lot on imports. By 2016, things started to look up a bit as the peso got a bit stronger compared to the dollar. But even though the exchange rate went up a bit, it didn't really fix the problem. Imports were still cheaper than locally made stuff, and our exports were struggling because they weren't making as much profit. This continued even in 2018, despite prices going up by 6.7%, mainly because our exchange rate jumped by 8%. The Herfindahl-Hertzman Index, or HHI, is a crucial tool for business proposal proponents to identify highly competitive and saturated markets, as well as those with high market concentration. It calculates market share by summing the squared market shares of all firms competing in a market. This helps assess competition levels and make informed decisions about market entry based on market saturation and concentration. The HHI can range from close to 0 to 10,000. The HHI expressed as HHI MS of firm 1 plus MS squared of firm 2 plus MS squared of firm 3 plus MS2 of firm N. A market's concentration and competition are directly related to its proximity to being a monopoly. A monopoly occurs when one firm holds 100% market share, where nearly perfect competition occurs when thousands of firms compete, with each having nearly 0% market share. This indicates a highly competitive market with numerous competitors. Results of the HHI would indicate the following. Number 1, HHI below 100 indicates a highly competitive market. Number 2, HHI below 1,000 indicates an unconcentrated market. Number 3, HHI between 1,000 to 1,800 indicates moderate market concentration. And number 4, HHI greater than 1,800 indicates high market concentration. And last, the business proponents should therefore seek to enter an industry where HHI is greater than 1,800 because the market is not characterized by too many firms.
Financial planning is a significant issue among older people, millennials, and the youth. Programs and daily papers offer advice on money, saving, and investing. Financial planners and consultants visit Filipinos worldwide to discuss proper budgeting and investing, especially advising our Filipinos on avoiding investment scams. Financial planners sees an individual long-term goal for the future, ensuring financial security and well-being. A financial planner, a sound plan, or individual can create their own plans without a skill. However, hiring a financial planner can be costly, so individuals may search online for guidance on creating their own future. To plan for the future. It is essential to evaluate an individual's current financial status and consider their goals. This includes determining their interest charge, saving for a grand wedding, and planning for a 15-year wedding with family and friends. Additionally, individuals should consider how to earn money, save, and determine the time it will take to achieve their dream wedding. For example, if someone wants to build or buy a new house in 20 years, they should consider their current financial status and the amount they need to save and earn. How to prepare a financial plan? The first step in creating a financial plan involves gathering the numbers that are needed. You can do this by researching from various sources to come up with a document or spreadsheet. First, calculate your net worth. Calculating your net worth is a crucial step in understanding your financial health. As a senior high school student, your asset may include savings, any valuable possession like electronics or jewelry, and perhaps a car if you own one. Liabilities could consist of any debts you owe, such as student loans, credit card debt, or loans from friends or classmates. Second, determine your cash flow. Understanding your cash flow is essential for effective financial planning, even as a senior high school student. By analyzing your monthly spending habits, you can gain insight into your income, savings, and potential investment. This process helps identify areas where you can cut unnecessary expenses and improve your overall cash flow. To determine your cash flow, first is monitor your spending throughout different seasons, such as holidays or the start of the school year, when expenses are labeled. For entrepreneurs, the key components of a financial plan include the following. First, retirement plan ensures financial security after retirement. Second, risk management plan minimizes risk in investments and expenses. Third, long-term investment plan guides in choosing stable investment like bond funds and stocks. Fourth, estate plan ensures assets are passed on smoothly to heirs, avoiding debt legacy.